Good morning everyone and welcome to our half-yearly investor webinar. I'm joined here today by Tim Warner and Jack Cherry from our investment team. The format of today's webinar will be familiar to those of you who have been on these before. I'll start with a quick overview of Totus and a reminder of the objectives and expectations for our Alpha strategy. We'll give you an update on recent performance, run through some high-level market observations, discuss current themes in the portfolio and touch on a couple of individual stocks and leave plenty of time for questions and answers at the end. This webinar is being recorded and a link to the replay will be available or made available after the session. Please note that the information provided in this webinar is general information only and is not intended to provide you with financial advice. It has been prepared without considering your objectives, financial situation or needs. There should be a disclaimer somewhere on your screen right about now. So Totus, we are an Australian-based absolute return manager founded in 2012. Our objective is to preserve and compound investors' capital alongside our own, regardless of conditions in the broader equity market and economy. Our investment team are partners in the business and aligned with the significant amount of our personal wealth invested in the funds. We offer a true alternative to traditional equity investments in that we aim to deliver positive risk-adjusted returns in all market environments regardless of the cycle. The Alpha strategy is a fundamental equity long-short strategy that uses themes to concentrate the investment universe and focus our research efforts. Fundamental bottom-up research is then used to identify companies exposed to those themes. The strategy has an open mandate. This flexibility allows us to select investment opportunities across all industry sectors and market capitalizations globally. Our conviction in these opportunities dictates the portfolio's exposures. We aim to deliver alpha or performance from both our long and short positions and always run a diversified short portfolio to provide protection during market volatility. The outcome of this approach over the last 11.5 years has been a strong track record of uncorrelated alpha. The Totus Alpha Fund has delivered 14.4% per annum net of fees since inception, with an average net exposure of 35% and minimal beta or correlation with equity markets. This equates to over 5% per year of alpha generation versus the ASX 300 accumulation index, including dividends, which is compounded at around 9% over the same period. We've made positive performance or alpha on both our long and short positions over that 11.5 year track record. And again, these returns have been uncorrelated with global equity markets and provided strong protection during down markets, delivering a positive 0.9% on average during down months for the ASX 300, including dividends. Our positive performance during down markets helps our investors smooth returns. Our investors that have long bias portfolios smooth their returns, allowing them to better navigate bouts of market volatility and hopefully hang on. Moving now to performance. After strong outperformance in 2021 in an up market and a strong positive return in a difficult market in 2022, 2023 got off to a slow start. However, things are improving with the strategy outperforming the ASX 300, including dividends, since our last webinar in March. Looking at what we could have done better so far this year, we came into 2023 cautiously positioned. We did not anticipate how resilient the Australian and US economies would be to record interest rate rises. Employment stayed full. No one outside of the tech industry lost their jobs. House prices went up, not down. Earnings didn't grow, but multiples or valuations expanded. And when we had the regional bank failures in the US in March, that was met with a flood of liquidity from the US Federal Reserve. As a result, stocks stayed up, and our shorts in retail, travel, and the banking sector haven't paid off yet. On the positive side, this year we did reduce exposure, our gross exposure, in late 22 after that strong run of performance relative to markets. We pivoted our short book back to Australia, where we typically do more of our shorting, after having a focus on the US market, which underperformed in 2022. That short exposure in Australia helped this year, as the ASX has underperformed the US markets so far in 2023. We added to our tech exposure after attending the Morgan Stanley Tech Conference in San Francisco in March. We found value in small and mid-cap quality companies such as Adobe that had been thrown out with the tech bathwater, and we largely avoided the artificial intelligence or AI hype stocks. We leaned into uncorrelated single stock short positions, for example, faddish and potentially fraudulent businesses that got to large market caps in and around index inclusion events. The net result is that despite being positioned for further downside in a rising market, our underperformance this year has been modest versus previous drawdowns. Our short book has recently started to perform, and we have an excellent spread of deep value long positions, as well as fallen angels that have limited overlap with the Magnificent Seven mega cap tech stocks, which have driven global equity performance so far this year. Looking at a chart of our long-term performance since 2012, it is clear that our performance can be lumpy, with periods of strong outperformance often followed by periods of sideways up and down before the next run up. Our key learning from the COVID-19 period was that we needed to do better during these periods of strong market performance after periods of market weakness when the fund had done well. If we could do that and start the next run of performance from a higher unit price base, it should help our long-term performance materially. It's deep drawdowns that kill long-term performance, and our drawdown this year has been modest. We are within touching distance of all-time highs for the fund and are making up ground on the index so far in 2023. We have started September well and are very excited about the current positions in the book and the opportunities set in front of us over the next few years. Turning now to market observations. We spent a lot of time on macro in our March webinar, so we won't go over it all again, but to summarize in a nutshell, the recession that we had feared at the start of 2023 hasn't eventuated yet. The yield curve, which has been the best predictor of recessions in the US since the Second World War, remains inverted. Stocks still look expensive relative to bonds. We do know that historically interest rate rises eventually slow the economy, but it takes time. The other lesson of history is that markets bottom during recessions and not before. So if we are in a new bull market, then it is a historically unusual one in that it has started before the Fed has started cutting interest rates and before we have had a recession. Time will tell if this is sustainable. So what's priced in? As far as we can tell, the prevailing market narratives are as follows. Central banks have defeated inflation. A soft landing or no landing is the most likely outcome in the US. This decline in inflation will allow central banks to again lower interest rates. Earnings will rebound in 2024, and this combination of lower rates and higher earnings will backfill the current valuations, which, as we said, look full relative to history and bonds. The other narrative that is very strong so far in 2023 is that artificial intelligence is a home run investment thematic that supports structurally higher valuations for clear winners. Now, the consensus may turn out to be right, but it often isn't. Our thinking is that if any of these narratives turn out to be too optimistic, it could spell trouble, or at least a bout of volatility for markets. Investors are now the least bearish they have been on stocks since early 2022, and sentiment indicators have swung from fear to greed. It's not too hard to imagine a number of scenarios that would debunk some, if not all, of these rosy consensus assumptions. I'll hand over to Tim now to talk about our current positioning.
Thanks, Ben. I will now talk through our current positioning and some portfolio themes within the book. We're currently running close to our historical average net exposure of around 35%, but continue to run lower than average gross exposures. We're still cautious, but open-minded, and the current positioning gives us room to move either way based off the opportunity set that unfolds over the coming months. Look, markets and indexes don't look cheap overall, especially relative to current interest rates, but we are seeing excellent pockets of opportunities within our current themes, both long and short. But before I talk to some of these themes and positions in the portfolio, I think it's worth reminding everyone of our investment process and portfolio construction. The Alpha Strategy has an open and flexible mandate, which we believe allows us to generate alpha by focusing on opportunities across global markets and not being constrained by an index, sector, or geographic region. This means our investment universe is large, and thus we need to narrow it down into a researchable opportunity set. We do this by identifying themes with clear tailwinds for longs and headwinds for shorts. From here, we perform fundamental bottom-up research on individual stocks and weight them based on the level of conviction, liquidity, and maturity of a theme. The opportunity set dictates the underlying portfolio exposures, but is then viewed through the lens of the risk manager, where we ask ourselves whether the overall exposures make sense within our view of the economic and market environment. This process leads to a balanced portfolio that has a range of long and short themes. Individual long positions tend to be more concentrated at 2 to 3 times the size of an average short position. Longs have strong fundamentals and shorts tend to have the opposite characteristics. We view longs as investments and aim to hold them for several years, whereas in the short book, we continuously trade and it's catalyst driven. As you cannot compound a short, we are looking to realize profits and rotate them into new ideas frequently. Now let's move on to some current themes within the portfolio. On the long side, we have high interest rate winners. With interest rates rising globally over the past 18 months, we have identified several high quality businesses that have had the additional benefit from capitalizing on high interest rates. The main positions exposed to this tailwind are Interactive Brokers, which is a founder-led, low-cost electronic broker that earns interest income on customers' cash balances and margin loans. We have AUB Group, which is an Australian small mid-cap insurance broking business that has negative working capital that they can earn interest on. And CME Group, which we have spoken about in previous webinars, but is benefiting from the increased interest rate hedging activity in an environment of rate uncertainty. Now, as we are most likely closer to the end of a rate tightening cycle, we believe the theme has matured and thus have started to add shorts in lower quality businesses that have benefited from the same dynamic as protection against a decline in rates. One example of this is Computershare, which operates share registries and earns interest income on customer balances. We have earnings quality concerns in the underlying business, with continuous restructuring charges being taken below the line, and the customer funds balance they're earning interest income is starting to decline. Now, another hedge against this theme is a bottom-up long idea in the US mid-cap market, that is founder-led, has a super impressive capital allocation track record, and operates as a service provider in our industry, of which we are a customer of one of their products. Now, you may be wondering, how has this got anything to do with interest rates? However, it is the balance sheet that is causing concerns in the market, with its interest bill rising meaningfully over the past few quarters. The debt is well within its covenants, and we are comfortable with the serviceability due to the predictability of earnings driven by sticky revenue from its services and products. Furthermore, the founder's capital allocation track record is excellent, and he sees compelling value in the stock, using half the free cash flow to buy back shares and the other half to continue paying down the debt. In an environment where rates begin to decline, the decrease in interest payments will lead to strong earnings growth and should alleviate any balance sheet concerns, leading to a share price re-rate. Now, a thematic we've spoken to in the past but are still there is the undersupplied commodities. Resources in 2023 have underperformed the overall market, with commodity prices falling from extreme highs driven by a normalisation of trade flows, reduced demand after elevated stockpiling during 2022, and a warmer than feared winter in the Northern Hemisphere. Now, at current commodity prices, we believe there is compelling value in this space and have resized up our exposures. We have seen signs of stabilisation in commodity prices and believe the cost curve for a lot of industries have shifted up over the recent inflationary period. These companies have net cash on their balance sheet, generating strong free cash flow and returning the capital to shareholders. The medium-term thesis of limited investment in new supply with stable to increasing demand should lead to upside price volatility, which is not being reflected in these valuations. Now, another pocket of alpha, which has contributed meaningfully over the past few months, is European and UK relative value versus Australia. The UK market has historically been cheap versus other global markets for a variety of reasons, such as index composition as well as Brexit. However, it was cheap relative to its own history, which piqued our interest for further investigation. Now, there are several businesses listed in the UK that have very similar quality business models to the companies listed in Australia that we know very well. Two in particular are Rightmove, which is the realestate.com equivalent, and Dominos Pizza Group, which is the master franchisee for Domino's in the UK. We were able to purchase both of these names at compelling valuations in an absolute sense, and extremely cheap relative to their Australian peers, and are core holdings in our long portfolio currently. Now, moving on to the short side, we continue to remain bearish on the Australian consumer as well as pockets of the US consumer. Now, despite wearing some pain over the last few months as people rotated back into consumer discretionary names, we think there will be an opportunity in the future to realise profits on our consumer shorts. Based on history, the first downgrade tends never to be the last, and interest rate increases tend to work with a lag, and excess saving buffers are still winding down. Now, on top of this, employment is still strong, and so any uptick in unemployment with the above, this could lead to further downside in the demand picture, and then on the cost side, we have strong labour and rent inflation coming through, which should impact margins. Another theme within the consumer space is in particular travel, and we mentioned our view on Qantas in previous webinar that we believed it was over-earning relative to history, and if you've been reading the news lately or travelled anywhere, there's not much more explanation needed. Other travel companies such as travel agents continue to have optimistic forecasts baked into consensus expectations and are crowded long ideas, which we think may provide opportunity down the track as earnings expectations may not be met. Another theme that we've initiated some new positions in are and had done well out of over the last few months is what we call price and volume unwind. Some names in this space are companies such as Amcor and Ansell, which are industrials that have benefited from price pass-throughs but don't have genuine pricing power, and their volumes are beginning to slow in the current economic environment. And so with a reversion in price and volume at the same time, it can lead to large operating deleverage. This is played out well in Amcor and Ansell. We still hold shorts in this space, but we're also seeing similarities in the supermarkets, where we think there's a compelling opportunity on the short side with expensive valuations at the top end of historic ranges, elevated gross margins off the back of inflation throughout COVID that could unwind with goods deflation, and labour cost pressures coming through over the coming year. And now finally, it wouldn't be a Totus webinar without talking about some fads, frauds and failures. This part of the market has always provided us with uncorrelated sources of alpha that pay off at very differing times as the catalysts play out on the short side. Jack highlighted one of these in our previous webinar, which was an ASX 300 inclusion. The stock is now down over 50% from its highs. We still see further downside in this one with a market cap greater than $700 million. It's got zero revenues, no commercial product, and has very questionable corporate governance. And then finally, with the recent index inclusion, we've also identified several names to do further research on, and at first glance, there's a few that look to have some smoke billowing. So I now pass on to Jack, who's going to talk through some individual stocks.
Thanks for that, Tim. As we mentioned earlier, over the past year, we've been looking to capitalise on the rapid change in interest rates by investing or shorting businesses that face direct tailwinds and headwinds from this external change. This targeted research led us to an investment in Interactive Brokers earlier in the year, which we believe is a quality business with a material earnings tailwind from interest rate hikes globally. Founded by the current chairman, Thomas Pettife, in 1977, who actually still retains an ownership interest of 75%, Interactive Brokers provides its 2.3 million institutional and individual clients access to about 150 markets in 33 countries globally. IBKR is a very customer-focused organisation with significant emphasis placed on automation for its trading, as well as its middle and back office functions. From this focus over time, these cost savings have been passed directly back to the customer in the form of lower brokerage and dealing services, which in turn attracts more customers, allowing the business to continue to pass back savings as they continue to scale. This type of scale economy shared business model was typified by Costco and Amazon, and we believe creates deep business loyalty, which combined with already high switching costs associated with brokerage platforms, has created a very sticky customer base for the business. This flywheel effect has effectively given IBKR growth in its customer base a 5-year compound annual growth rate of 33.4%, and with EPS growing on a 5-year CAGR over the same time period of 28.2%. Whilst the core business has performed well over the past 5 years, there had been this dormant driver of earnings growth which has been revealed with the latest global hiking cycle from central banks. On its balance sheet, IBKR holds about $365 billion of customer equity, of which $61 billion is held as segregated cash, primarily from its prime broking services and margin loan collateral. IBKR is then able to invest this cash predominantly in short-dated US Treasuries, whose yields have risen from 0 to roughly 5.4% in the last 18 months. This has created obviously a significant increase in high margin interest revenue, with interest income from segregated cash increasing from $2 million at the start of 2021 to about $700 million as of the last quarter, Q2 2023. IBKR remains pretty risk averse with its cash investments as well, with the average maturity of its treasury investments only at about 40 days, along with holding $12 billion in excess equity on the balance sheet should anything unexpected occur in the future. Should interest rates continue to rise or even just stay where they are in a higher for longer scenario, IBKR should be able to continue to experience an extended period of elevated earnings. With the valuation beginning to reflect the elevated earnings base that the company will experience this year and beyond, we had trimmed the position slightly. However, we remain positive on the growth trajectory over the long term from here. In addition to IBKR, and as Tim mentioned earlier, Dominos Pizza Group, the UK-based Dominos Pizza franchisor, has been a meaningful contributor to the fund, especially over the last 2 months and previously since the last webinar that we did. Dominos Pizza Group has been the master franchisee for Domino's UK since 1990, and having had success in the UK market, the company had attempted to expand across adjacent markets and into Europe in pursuit of an accelerated store rollout. Whilst the European growth opportunity appeared great, the outcome was less so. The store rollout in new markets created a meaningful drag on group operating performance and profits, while at the same time shifting management's focus away from its core, highly successful UK and Ireland franchisees. Unfortunately for the business, an improvement in European markets trading for Dom never arrived, leading to the decision in October 2019 to exit all of their directly operating international markets. This repositioning took time, and Dom only exited its last ownership stake in Germany earlier this year, selling its portion of the joint venture actually to the Australian master franchisee DMP. Whilst the lower growth runway, obviously from a UK and Ireland focused business, appeared as a negative initially, the shift in capital allocation and the resulting valuation at the end of 2022 was something that really excited us. In 2020, the board undertook a strategic overhaul of the business as well as its capital allocation policy. The success of a franchisor business stems directly from the health of its franchisees, and it was clear that following the company's misadventure into Europe that its relationship with its core UK franchisee base was quite strained. In December 2021, Dom reached a resolution with its franchisees aimed at improving collaboration, alignment, and accelerating the company's growth in its core region. Additionally, a new capital allocation framework was enacted at the same time, aimed at investing in the business to drive long-term organic growth, sustainably increase the dividend, and return surplus cash to shareholders via buybacks. Since this change, the business has returned around £315 million to shareholders, or roughly 27% of the market cap as of July of this year. At the end of 2022, Domino's UK was trading on roughly 11 times earnings versus a 30 times earnings multiple for Domino's listed on the ASX here. As the year progressed, UK's Domino's operating momentum continued to improve with inflation in energy and prices and input costs reversing, and we saw a re-acceleration in same-store sales growth combined with their ongoing buyback. Over time, we became incrementally more positive on the business's earnings growth profile and the stabilisation that we saw in operating conditions following quite a volatile trading period over the preceding 2 years. We increased the position in early July, believing the market was undervaluing the quality of the asset-light franchise business, its extensive capital returns program that was in place, and that the assumptions required to achieve a low double-digit return over the next 5 years were quite undemanding. The announcement of the first half results on the 1st of August confirmed these thoughts. It saw an upgrade to the business's full-year earnings expectations, along with the announcement of a new £70 million buyback facility. Following this news, the share price subsequently re-rated 45% since the result, and whilst we have since trimmed the position back following this increase, we still remain positive around the long-term trajectory for the business, and their stringent capital allocation framework should provide adequate shareholder returns. I'll now pass back to Ben to wrap up the webinar.
Okay, to try and summarise what we've just been through, we think it's a great environment for stock pickers at the moment. We can see clear dispersions in valuations and prospects across industries and geographies. Higher interest rates have levelled the playing field for long-short strategies like ours. Bad businesses now have a shorter runway to perform because investors have an opportunity cost on their capital. Strong consensus narratives open up contrarian opportunities for bottom-up independent investors like ourselves. After a period of performance consolidation, we were excited by the fund's current holdings, and as a team, we've been adding to our holdings in the fund in recent months. Okay, so now I'll pass it over to Tim to go through some questions.
Alrighty, thanks Ben. We've got a few questions coming through and some that have come through earlier, so we'll jump straight into them. The first one we got is, How is the portfolio positioned in order to reverse the market underperformance for the year to date?
Okay, it's a good one to start. So as we touched on, we've gone through some of the positioning, some of the stocks that we have high conviction on in the presentation earlier, but we're not that far behind the market year to date. Our returns are uncorrelated to indexes, and we've had numerous periods over the last 11 years where the index has outpaced the fund for a period of months or even quarters. If we were to see any of those consensus narratives that we talked about earlier in the presentation turn out to be false, we think that there's an opportunity for a strategy like ours, which does well during periods of market volatility, to gain ground on the index very quickly. I think we'll leave it at that.
Yep. Okay, next question we got is, what's the outlook over the next 12 to 18 months with respect to inflation, the economy, and what's the subsequent portfolio positioning?
Okay, yeah, that's a good one. I mean, that's the major question. We suspect that the consensus that inflation is done is too optimistic. We can see a number of things that are starting to bubble away beneath the surface that might point to trouble ahead. We have the oil price, which is up about 25% since the last webinar we did in March. There are a number of other things: cost of housing, cost of electricity, wage pressures that are just starting to feed through, and that could cause a resurgence in inflation later this year and into next year. That would be a big blow to the expectations of the market that interest rates will come back down and support stock prices. The expectation that earnings will grow strongly in 2024 is also aggressive in our view. Given we haven't had much of an earnings decrease or trough in 2023, it's difficult to see what's going to drive a large amount of margin expansion and top line growth in 2024. So putting that all together, we're running lower than normal gross exposure and at about our average net exposure, which has historically allowed us to perform well in falling markets. If we were to see evidence that those risks are emerging, we could reduce our net exposure quite quickly and potentially make positive returns in a falling market.
Yeah, and I think just to add to that, in terms of themes within the portfolio and the positions there in regards to inflation and the economy, we've got bets in both directions. We're not just one-way bets. So if the economy slows in Australia, we have consumer-facing shorts on. But if the economy remains strong and inflation picks up, well, we're long resources through our undersupplied commodities. So you've got exposures to different scenarios that play out rather than a one-way bet on one thing happening.
That's right, and I think the example Tim did earlier in the presentation about some beneficiaries of higher interest rates, but also some companies that might benefit if interest rates were to fall, and having a mix of those in our long book, gives us scope to lean in and not have the fund all a one-way bet on a forecast that might turn out to be wrong.
Okay, well, it's a good question leading on from interest rates. Do higher interest rates impact the fund's shorting strategy? If so, will this have implication for the fund's net exposure?
Yep, no, that's a good question. So we've been telling investors and talked about previously on these webcasts that the period of zero interest rates was the most difficult period for our short book in the fund's life. With zero interest rates, there's money is plentiful. People don't have alternatives to try to generate growth, and they give a lot of runway to profitless companies heavily indebted companies because the opportunity cost or carrying cost of owning those investments is low. So the flip side of that is that higher interest rates are actually positive or increase the opportunity set for our short book. It reduces the runway available to cash burning businesses or heavily indebted businesses to try and grow their way into their valuation. We've got a range of companies that are loss making in our short book, and also a smattering of highly indebted businesses in our short book. So the longer interest rates stay high, we think that is potentially a net positive for our short book relative to the opportunity set we saw when rates were back at zero.
Okay, got another question here. The thoughts on the current growth rally, any prospects for more rational pricing? And then another question that's probably similar, current thoughts on the Magnificent Seven.
Magnificent Seven.
Tongue twister.
Great movie. Okay, so thoughts on the growth rally. Yes, it's true that the index performance in the US in particular has been driven by 7 mega cap stocks that have AI exposure or perceived exposure to the AI thematic. So far, on an earnings basis, the only one that we can see out of that 7, off the top of my head, Tesla, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Microsoft. Perhaps I've already said that, but the only one that I think has a clear earnings benefit from AI is Nvidia, and we think that that stock is too hard at current levels. It may turn out to be a home run, but it may also turn out to be the Cisco of this tech cycle, which is priced in a decade plus of growth, and the stock may not do anything for a long time from here. The chip industry is traditionally very cyclical, very difficult to get a read on, pull forward of demand, and it's known for having flat spots and volatile earnings. The companies that we do think are reasonably priced in that Magnificent Seven group are Alphabet, Amazon, and Meta, and we do have holdings in those 3 companies. The others, we think have rallied largely on the expectation of earnings, which are yet to eventuate from AI. We've owned Microsoft. We still own Microsoft in the fund, but it's a smaller position than it has been. We think it's priced in, a lot of growth from this AI thematic that is yet to eventuate. The other one that looks fully priced relative to the earnings growth that it's delivering is Apple. So Nvidia, too hard. Amazon, Alphabet, and Meta look actually quite attractive to us at these prices, and Apple and Microsoft relatively fully priced for the growth. Tesla, sort of probably disqualified from talking about Tesla too much, but earnings have actually gone backwards this year, despite the shares, being strong performers.
Okay, I think we've got time for one more question. Got one here. Can you provide your highest conviction company on a 5-year outlook?
Okay, this is this is a good one. We had this question from the AFR just a few days ago. So CME Group is a good one that for this type of question. For a company to be a good investment over 5 years, it has to be around in 5 years, and the CME Group was formed back in 1898, so it's been around nearly 125 years. It is a monopolistic exchange for interest rate, commodity, currency, and stock index futures. It's currently trading at similar prices to where it was trading in 2019, so you've had almost 4 years of sideways in the share price, and yet the earnings per share for CME Group is nearly 40% higher than it was in 2019. Now, the stock has derated or gotten cheaper over that 4-year period because of the zero interest rate environment. There was less uncertainty about interest rates when they were pegged to zero. Now, CME benefits as people try to hedge their interest rate exposure, and the lift off of rates from zero with the re-emergence of inflation and the massive deficits that the US government is running, which require massive amounts of bond issuance. They're all three very powerful tailwinds for CME Group. So that is one of our largest positions in the US part of our book.
Alrighty, that's it for questions for now. So we'll wrap it up now.
All right, thanks everyone for dialing into this webinar. Please come through with any questions we missed, and as always, we're happy to meet with you in person, or you can talk to Lisa Pierce, our head of distribution. We'll see you in 6 months.
Thank you.